Hey everyone, welcome to another video. I'm going to cover the bank reconciliation problem. So this is a type of problem that you would see in an introductory financial accounting course. The textbook I use in my courses is the Corporate Financial Accounting 16th edition by Warren. It is published by Cengage. So you want to use try to find something that's similar to the textbook that you are using. Bank reconciliation shouldn't differ too much though from textbook to textbook, so you should feel pretty safe if you're in introductory financial accounting. But always verify with your professor if this type of video would work for your particular course. Okay, so I'm going to cover a type of problem you would see in a bank reconciliation. So we'll do the actual bank reconciliation first, and then we'll do the journal entries that follow a bank reconciliation once we get it completed. So the goal of a bank reconciliation is always to reconcile what is showing on your books. So what's showing in your records in your general journal versus what the bank is showing. So these are always typically going to differ because of things like we made a deposit, but it hasn't posted in our bank account yet. Maybe a customer has dropped off a payment directly to the bank. They have sent it directly into the bank, but it hasn't been recorded on your books yet. Things like that. So those things that are pending and haven't been recorded. You also can find errors this way. So maybe you transposed a number when you were making a journal entry. So that could be a difference between your bank records and your books. So it's good to do a bank reconciliation at the end of every month just to make sure that the amount that is showing in your books is correct and that something isn't, like I said, an error or things that have been dropped off at the bank, or maybe the bank made an error too. So it's always good to verify this at the end of every month. So that's the purpose of a bank reconciliation. You can also do this on your own too. Typically, people don't do it as much as they used to, but it was called balancing your checkbook. Most people don't write checks too much anymore. But you can do a variation of this based off of your online records through your bank too. So let's go ahead and look at this problem for Meyer Company. So the following data were gathered to use in reconciling the bank account of Meyer Company for the month of May. So we have different items that can cause a difference between what our bank records are showing and what our books are showing. So the first thing you want to do is put on your bank reconciliation, what does the bank say your balance is? So right now the bank is saying our balance is $18,750. When I go to open my ledger, it says my balance is $11,590. Well, that's a big difference, and I want to know why. What is the difference between these two records? Why are they so far apart? So I want to go ahead and put those balances on my bank reconciliation here. So my balance per my bank statement says it's $18,750. So those are the two things I want to go and throw in first. Balance per my books, however, says it's $11,590. So I need to drill down and figure out what the difference is. So I came up with these transactions here. That is possibly the reason for the difference. So it says I have bank service charges of $30. So that's showing up on my bank statement, but it's not on my books yet. So it's something that the bank charges me. So anytime you have something like this, you always want to record it on the bank reconciliation in the area that it's not showing up. It's already in the bank statement, so I don't want to do anything up here. I do, however, want to adjust my books for this. So a bank service charge is a subtraction because it's money they're charging you to have a bank account. So I'm going to go ahead and put the balance and adjust the balance per my books for that bank service charge under the deduction part of it because it is going to be a subtraction from my records. So they charged me $30. It's already updating. I have the Excel spreadsheet to update my totals. So if you have your own business, it's good to have some sort of Excel spreadsheet like this so you can just throw these items in and it'll automatically adjust it for you. You don't have to do a lot of calculations then. So that $30 is a subtraction from my books so that I can update. The goal at the end of this is to have the adjusted cash balances match. So you can still see I'm different. I have a different balance here. So I'm going to keep going. My deposits in transit were $37.50. A deposit in transit means I've dropped off the deposit at the bank, but it hasn't posted to my account yet. So it's missing up here from my balance per my bank statement. So I have deposits in transit of $37.50. So I want to go ahead and add that to my bank statement balance. So again, I still have a differing balance here. It's already automatically updating my balances. All right, then I have a note collected by my bank with $160 in interest. So it was a total of $4,900 that basically the client dropped off at the bank to be deposited in my account. So a note is a type of a loan, so they're paying me back. So that's money that's coming in. It's already on the bank statement, so I don't want to put it up here, but it's missing from my record. So I want to go ahead and add that to my book balance. So note collected by bank. I'm going to put the total amount of $4,900 here. That interest amount is going to be important when we go to record our journal entry, but we don't need to separate it out up here on the book side yet. All right, so I've go ahead and adjusted that. It's automatically updating my adjusted cash balance. You can see I still have a difference there though. And I also have some outstanding checks of $6,040. Outstanding checks means I've written a check, but whoever I wrote it to hasn't cashed it yet. So it's missing off of my bank balance. It's already showing up in my books because I've already recorded it, but my clients haven't cashed it yet, so my bank statement balance has not been updated yet. So I'm going to put outstanding, if I could spell, outstanding checks in the amount of $6,040. All right, so you can see after I've updated my transactions here, my adjusted cash balance now matches. This is the correct amount of money that I have. So originally it stated that in my books I had $11,590 and my bank statement said I had $18,750. Neither one of those were correct. The correct amount is $16,460 after adjusting for these items that were either lacking on the bank statement or lacking in my records. So what the question is asking us for is to prepare a bank reconciliation to get the adjusted cash balance for the business. We did that part. So we have an adjusted cash balance of $16,460. And then they want us to prepare the necessary journal entries. What it means by that is I need to update my records. I need to update my records for these items that were not on there. So I need to go ahead and make a journal entry so that after I make these journal entries, the balance per my books is going to show at $1,460. So I make these journal entries, I post them to the ledger, and that will update my balance per my records officially so I can show that $16,460. So I want to go ahead and update down here and create my journal entries. So I'm going to have two different journal entries because I have one addition and one subtraction to cash. So I need to go ahead and record those. So this is for the month of May. Typically bank reconciliations are done at the end of the month. So I'm going to go ahead and assume that's what we're doing here. Oops. So 4/31 would be the last date in May. And the first one I need to update for is the note that was collected by the bank. So it's an increase to my cash. So anytime you're increasing cash, you're going to debit it. So let's go ahead and update my cash balance by the $4,900 in total. And you know, every time you have a debit, you at least need one other credit, right? And they have to balance. So we did a debit for $4,900 to cash to increase that. Then we need to go ahead and make our credit. And so this is where I need to account for this interest amount here. So somebody paid a note to me. So I had a notes receivable for this. So I need to show that they've made the payment by reducing their notes receivable. So I don't have that. They paid me money. So they no longer owe me that money. So I need to reflect that on my statements to update their balance. So I'm going to go ahead and credit my notes receivable. So indent for a credit. And the amount for my credit is going to be equal to that $4,900 minus the $160 in interest, because that interest part is separate. That's something they owe me on top of the principal balance. And the principal balance is the amount that is shown in the notes receivable. So I'm going to reduce their notes receivable by $4,740, which is that $4,900 payment minus the interest of $160 that was received. As you can see, we don't balance here yet, so I'm missing something, and that is that interest. So I'm going to have to do another credit, and it is an account title called interest revenue because it's something you are earning based on a loan that you gave somebody else. So I'm going to record it as interest revenue of $160. Now I have at least one debit, at least one credit, and now they balance. So I can go ahead and I already took care of this $4,900 amount up here for the books. Now I need to adjust for any deductions to my books. So I'm going to go ahead and put the date in here. So a subtraction to cash would be a credit to cash. So I know what my credit is, but what I don't know is what my debit is. And so I don't have a chart of accounts listed here. There could be a type of account called bank expenses. Most likely it's going to be in your textbook for an introductory financial accounting. A bank service charge is going to be a miscellaneous expense. It's just those small expenses that you have every month that you don't want to separate out. So I'm going to go ahead and assume it's going to be a miscellaneous expense. So anytime you increase your expenses, it is a debit. So I'm going to go ahead and debit my miscellaneous expense. And then I need to reduce my cash because that's cash going out. And to do that, cash is a type of an asset. To reduce it, you credit it. So I have at least one debit, at least one credit, and they now balance. So that is how to do a bank reconciliation and the corresponding journal entries that go along with a bank reconciliation. If you have any other questions or you'd like to see any additional videos for introductory financial accounting, cost accounting, taxation, comment below. You can subscribe to the channel to get updates on any videos that come out. I'm going to be constantly creating more videos as the years go along and standards update too. So I hope you all enjoyed this video, and happy accounting.